All right, so in this video, I'm going to talk about the security market line. So the security market line is basically just a plot of the CAPM, the capital asset pricing model. So you can go back to the video I posted about the capital asset pricing model. And basically, I'm taking that formula, that equation, and I'm plotting it. And so basically, if we go back and we kind of review that for a brief moment, basically, I've got this equation down here, which is the capital asset pricing model. What we're going to plot is we're going to plot the betas for investments and the returns for the investments. So betas and returns. Now, if I look at this equation here, what you'll see is, you think way back to algebra, this RRF, this risk-free rate, that's basically going to be my intercept of a line. So this is going to be my intercept of a line. This is going to be my slope. The expected return on the market minus the risk-free is going to be my slope. This beta is going to be my x variable. This return is going to be my y variable. So basically, all we're doing is we're plotting this equation, and we're calling that plot, and the line that we can draw on that plot, the security market line. So I'm going to plot betas, I'm going to plot returns for a bunch of stocks. And basically, we could put, to use a fancy term, we're going to do a least squares best fit line. Basically, we draw the best line we can through the data points. So I take the betas and returns for a whole bunch of stocks, plot them on a graph, put the best line through that I can. And the plot that I get is the SML, or security market line. So if that model is working correctly, so if that capital asset pricing model works right, then basically the intercept of that line ought to intercept the y-axis right there at the risk-free rate. So that would be basically what should happen. And I'm going to go to the next slide here and then come back for a moment. Basically, this is the graph that you ought to get. So if I plot a whole bunch of betas on the x-axis, the expected returns on the y-axis, basically what ought to happen is I get all these little dots right along this line. Okay, so this solid line here is the security market line, or SML. So everything ought to fit nice and neatly along that line. All right. Now, I'm just going to sort of note something in passing. There is another way to view that capital asset pricing model equation, and that is, instead of treating the market risk premium, the market expected return on the market minus the risk-free rate, as the slope, you could actually flip that and treat that as the x variable and the beta as the slope. And you're like, well, why would I ever want to do that? Just as a side note, if you did that, we just need a market rate and a risk-free rate, and then I need the returns for the stock. All of those are reasonably easy to find. And so if I had those, I could plot a whole bunch of data points for that, and then actually do a trend line on that plot, which would be a little bit different from the SML because I'd be using a different x variable. And if I do that, basically what should happen is the slope of the line that I get there is actually beta. So it's just sort of a little side note. If you needed to calculate beta, you could actually kind of rearrange that formula and do it by doing trend lines. Which, if you go on to, if you're doing graduate study or something like that in finance, you might wind up doing something along that line. But just as a side note, that's kind of one way that you can actually calculate betas, is actually by rearranging the CAPM and looking at it a little bit differently. But all that aside, basically, one of the things that's worth noting here is that if I'm looking at that graph, notice that this risk-free rate is that intercept point. And that risk-free rate is made up of the real risk-free rates, which is what a person would charge in a completely perfect world, plus an inflation premium. Now, inflation can change, and our expectations about inflation can change. So if our expected level of inflation changes, this risk-free rate is going to change. So this dotted line here would actually kind of shift up and down as the risk-free rate changes, which basically means this whole line would shift up and down based upon what people think is going to happen with inflation. So all that to say is, basically this graph is plotting that CAPM, which is a risk-return kind of connection or trade-off, and showing how much return can I get for how much level of risk. But basically, as people's expectations of inflation change, that graph is basically shifting up and down, and people are expecting more or less return basically based on what kind of inflation they think is going to happen. Okay. So changes in expected inflation are going to affect the risk-free rate and therefore the intercepts. That whole line is going to kind of shift up and down based upon what's happening with what people think is going to go on with inflation. Now, risk aversion actually affects the slope. So if people are really risk averse, what that means is they need more compensation per unit of risk. So in other words, if I take on this 1 unit of risk here, or up to a beta of 1, if they're really risk averse, they would want more return. And so this whole line could shift upward, or I should say the slope would shift upward or change, or tilt, I should say. The slope is going to tilt this direction, basically saying investors want more return. So here's how that could apply. If investors get particularly fearful about economic circumstances, they might start requiring higher rates of return to invest generally, like in everything. They might require higher rates of return. If they start requiring higher rates of return to invest in things that are risky, the angle or slope of this line could shift up, basically saying investors want more return per unit of risk because they're fearful. On the other hand, if investors are super optimistic and not fearful at all, then what can happen is the angle of this line could shift down, or slope of the line could shift down, saying that investors aren't requiring as much return to induce them to take on risk. Okay. And so what happens then is basically as investor attitudes, as their risk aversion shifts, if they get particularly fearful or particularly optimistic, what could happen is the angle or slope of the line can actually kind of tilt, and it'll change depending upon whether people are more risk averse or not. And so ultimately, if you're looking at this, if the model is working well, if I plot the beta and returns for all these different investments, whether it's stocks, bonds, real estate, whatever, the idea is theoretically it would fall nice and neatly along the line. And as an investor, my goal would be to decide where along the line I want to be. So if I'm really risk averse, I really don't like risk much at all. Maybe I'm closer to retirement. I might create a portfolio that's kind of close to that risk-free rate where I'm taking on not a lot of risk at all. And so I make a portfolio that's kind of around here. If I'm maybe a younger worker saving aggressively for retirement, and by means of saving aggressively, I mean I'm really just putting money aside for retirement. I got years to go before I hit retirement. I might be much more tilted towards investing in the entire stock market. I don't have much in the risk-free investment at all. I'm much more invested in risky investments because I'm willing to take on some of that risk because I'm hoping to get the higher return there. Now, a little side note. That doesn't mean that I'm making stupid risks, right? This whole model, the CAPM, was assuming that we have a diversified portfolio. So we've diversified to the point that I have eliminated the diversifiable risk. The idea would be that maybe I have tilted my portfolio much more towards stocks, not as much towards, say, bonds, for instance. And so I would have maybe a portfolio I expect to get a higher return on average, but also has more risk exposure. So the idea would be if this model is working well, I can kind of pick where along the line I am, depending upon which mixture of investments I put together in my portfolio. And therefore, I sort of decide my risk return combination that I'm comfortable with. And I just pick that spot on the line. That's the idea, if the model works particularly well. If the model is not working real well, and maybe that means that there are some stocks that aren't on the line. So instead of stocks or investments all being on the line, maybe there's something up here and something down here. Well, if there's something here, this is offering a much higher amount of return relative to the risk than something on the line would be at that same level of risk. This would look really attractive, right? And so I'd want to invest in that. If I had something like over here, this has all kinds of systematic risk exposure. It's going to add all kinds of systematic risk exposure to my diversified portfolio if I did it. But I have like virtually no return to show for it. This would be terrible, right? So I would want to avoid anything that was over here. So if not everything was on the line, if the model's not working quite right, the stuff that's above the line would look better, and the stuff that's below the line would look much worse. Hopefully that gives you some insight into kind of the CAPM and the security market line. Thank you so much for watching, and have a great day.